Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, it's kind of a two-parter. We are going, and by we, I mean me, are going to get you to truly understand risk tolerance and asset allocation. So we're actually going to split the episode into two. The first part, we are going to talk about risk tolerance and what you should know and what you need to ignore. And then we're going to talk about asset allocation. These are two topics that are talked about a tremendous amount within the industry and actually outside of the industry. But unfortunately, they are overblown to an immense degree. And in some cases, the topics are just simply not appropriate. And I'm actually going to talk about that in the episode. But before we dive into the episode today, if you have any interest in the books, the courses in previous episodes, you're going to want to head over to capitalizepodcast.com. That is our hub where you can get all of our content. So without further ado, we're going to get into part one, which is understanding the risk tolerance. So first off, I want to explain to you what risk tolerance is within the eyes of my industry. So there's no set in stone definition of risk tolerance, but I'm going to give you the kind of back of the napkin definition, if you will. Risk tolerance is what someone is willing to take when it comes to volatility in one's portfolio. So in the eyes of our industry, if you have a portfolio and you look start to finish and your portfolio is going up and down minimally, I would say that is considered a conservative risk tolerance or a conservative portfolio. If you have a portfolio where the dollar amounts are bouncing up and down more moderately, that's a more balanced or moderate middle of the road portfolio. And then lastly, if you've got one where there's just swings all over the place till kingdom come, that would be something that is considered more aggressive. Now, the reason why I bring that up is I want to take a trip down memory lane for you all to when I started in the industry at the time, the largest wealth management company in the world. So when I was an intern, which was 2008, I remember vividly a lot of people were very upset and actually frantic coming into these offices. And I remember looking at these financial plans and looking back even months before they had met with their advisors and their planners. And by they, I mean the clients. And one thing that struck me odd was how back in February or March of that year, because again, my internship started September, October of 2008, which what a time. So February, March, you looked at these plans, and according to these plans, the success rate for these financial plans was like in the mid 90s. Okay. So pretty much a done deal that you're going to be okay. But basically all of these plans at September and October, when we were meeting with these clients, suddenly the success rate was, it wasn't nothing, but it went from 95 to 20. And I remember thinking, I don't know what's going on, but I know what's going on right here is what not to do. And they were using something called a Monte Carlo simulator. Now, I've actually tried talking about this in the past regarding how Monte Carlo simulators are not only not ideal, they actually don't really work all that well. Compliance can get a little touchy on that one, so I'm going to let that slide for now until they let me talk about it more. But I remember after my initial internship thinking, I've got to find a better way to get people to understand what risk tolerance is, because clearly that's not applicable. Like all risk tolerance went out the window because these people are now going, can I even financially make this happen? And a lot of people couldn't. Now, one thing I found and this was probably 6 or 7 years after I left the big firm. So a couple years into me doing what is now Capitalize Your Finances, I remember researching something called the Dalbar study. Now, for those of you that have read my book and have taken my master class, you know that we talk about this a pretty extensive amount, especially in the book, because it's really valuable. The Dalbar study is a study, and generally speaking, a bank hosts it every year, but it's actually a nonprofit study that tracks how different investments have done over a multitude of years, but it compares how the average investor has done according to traditional financial advice. And I remember when I was doing the research for my book, the Dalbar study that I used, it was a 20-year period, and I'm pretty sure it was 1990, I think it was like 1996 to 2016, okay? And the reason why that's mission critical, that was a pretty volatile 20 years because you had the dot-com correction and then you had the Great Recession. So this is not investment advice. This is just the bare bones facts. The S&P 500 over that period of time did about 8.5%, give or take. And it was interesting because over that period of time, bonds, like a bond portfolio, did about 6%. I'm not going to get into the weeds of that because I could say that there were some flaws there, but it's neither here nor there. And then inflation was about 2.5%. The average American that invested according to what our industry perceives as traditional and appropriate investment advice, lost to inflation by 0.5%. I remember reading this going, oh my goodness, that's it. Like now I have something quantifiably to back up. And so this is why risk tolerance as we know it today is totally flawed. And I'm actually going to use an example here. So let's say that you're in your mid-20s and you go to an advisor or a planner, or you're just trying to research on your own for investing. And let's say that you are considered a conservative investor according to what our industry has inappropriately educated you on. If you have a conservative investment risk tolerance, you're actually setting yourself up, if you're in your mid-20s, for a lifetime of failure, and here's why. According to this industry, if you went to an advisor or a planner and you said you had a conservative risk tolerance, you would only be able to be provided really short-term investments that are not all that volatile. So, savings, checking, money market, CD, bond, that's basically it. And the bummer with that is if you're in your 20s and you're going to retire in your 60s, okay, you've got this runway where you're probably going to earn a pretty conservative rate of return. But that's a huge red flag because you're going to have to aggressively save so much more. And the bummer with that strategy is you probably don't have that in you. Think about it this way. If you had a quote-unquote aggressive risk tolerance, you could actually invest for the long term, stomach that temporary volatility. According to my book, we've written about this. We know that there's never been a 15-year period where the stock market hasn't earned a positive return, and there's never been a 25-year period since 1950 where the stock market, specifically the S&P 500, has done a bare minimum of 7.98%. But I'm going to round up and call it 8. My whole point is, even though you are, quote unquote, investing aggressively, your plan actually got a whole heck of a lot more conservative and easy in the fact that your money is working a lot harder for you over that period of time. So you may not have to save as much because your money is earning that return to make up for it. And from a risk tolerance standpoint, if you succumb to what our industry is talking about, you're actually shooting yourself in the foot. That's a bummer. That's a huge bummer. Now, I want to actually close out before we get into the commercial break how you should actually view risk. And there's two ways to think about risk. There's risk in the financial planning sense, and then there's risk in the investing world sense. And they are totally different. And risk is a very dynamic and fluid term. But when it comes to the planning standpoint, my definition of risk from financial planning is what are the odds that this plan is going to work with the dollars that I have appropriately allocated to the plan given the unit of risk that I'm trying to achieve. Now, there's not going to be a test after this, and you're probably going to have to go back and re-listen to that a couple times because it's very loaded, but it's a whole heck of a lot different than, well, how do you feel about investing? I don't know. Most people have no clue. From a planning standpoint, understanding what are the odds from a risk standpoint that this plan fails? Now, from an investment standpoint, it really depends on what you're investing in. If you're investing within a stock, just as an example, there is a litany of questions that you got to ask yourself. In fact, one of the things that I'm working on is building out my checklist. There's a book called The Checklist Manifesto. It has nothing to do with investing. It actually has to do with neurosurgery. And this neurosurgeon, I believe he was the first neurosurgeon in the country to start building out his own checklist so that when he goes into brain surgery, shocker, that's a big deal, there was no stone left unturned. I've taken that mental model, which I've spoken about in previous episodes, and I've applied that to the mental framework of investing in a stock. You should have a never-ending checklist of questions if you're going to do this on your own. And if you have an advisor or planner, you should ask them what some of those checklist items are that they're going through. And if they say that it's always just a set in stone thing, you need to find a new one. It's the same thing with investing in real estate, with a privately owned business, with a bond, with a preferred stock, with a lending company, private credit, with a hedge fund company, with an annuity. It doesn't matter what you're investing in. You need to build out these checklists, and that's the way you are going to understand how risky an actual strategy is, not just if it goes up and down every single day. That's not risk. Okay, that's just volatility. And just because something is volatile, that does not mean it's risky. Now, we are going to take a quick break. We're going to head on over to commercial. I'm going to take a sip of water, as I always do. And when I come back, we are going to transition into talking about asset allocation, the do's and don'ts, and what you need to do about it.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotu, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. The first part of this episode, we talked about risk tolerance, the do's and don'ts. Now what we're going to do is transition into a pseudo-similar topic on asset allocation. Risk tolerance it's a much more comprehensive topic in the world of finance because it really spans across everything. When it comes to asset allocation, that's a much more tactical definition that we're going to discuss, and it's very finite. I'm going to tell you, I'm going to first start off with asset allocation, what it traditionally means. So if you've ever invested or you work with an advisor or a planner, and let's say you get a monthly statement, whether it's online or in the mail, whatever. When you look on this statement, there's generally speaking this pie chart, and this pie chart breaks down all of these different investments that you have, whether it's cash, individual stocks, mutual funds, index funds, bonds, whatever. And, you know, it's easy to understand at that point from a 50,000 foot view what you own within your portfolio. Now, I'm going to tell you, asset allocation, it is important, but in our industry, it is promoted as this end-all, be-all thing, and it's fixed. And asset allocation, it's not a fixed, set-in-stone thing. It is very similar to the risk tolerance. It's dynamic. Okay, you've got to be very nimble in the mind when it comes to asset allocation. So, like, people ask me all the time, what is the ideal asset allocation? And the answer is going to shock you. You kind of have to figure it out on your own. So I'm actually going to use 3 examples, 2 of which I've had on my show, 1 of which we are working on. I would love to have him on our show. 3 of the best investors I know: Monish Pabrai, Guy Spier, and Gautam Baid. So they're all phenomenal investors, but they have their own tolerances. And what I mean by that is Monish is a big believer, and he preaches about this a ton, of something called the 10 by 10 method. So if you had 10 stocks and you allocated 10% of the portfolio to each one of them, that would be an adequate allocation for him to recommend to people as far as starting. And there's a ton of research that he's done behind the scenes to prove that point. Now, Guy Spier, who I've had on the show, and that was an amazing show, Guy has a different tolerance and an appetite for investing than Monish. They both invest within the stock market, but unlike Monish, who may be more of a 10 by 10 guy, Guy might have somewhere between 15 to 20 or 15 to 25 different companies. So by definition, you are spreading your dollars out over more companies, and so there isn't as much concentrated risk within each one of those companies. But all things being equal, someone like Monish, if they both have the same company within their portfolios and it goes up, with Monish's, you're going to feel it a whole heck of a lot more because there's more of a weighting to that company. But on the flip side, if it goes down, you may feel it more within Monish's as opposed to Guy. Again, they're both 2 of the best investors in the world, but they understand their tendencies and their flaws and their pros, and they're allocating their portfolio and actually their minds accordingly. And then you've got someone like Gautam, who, Gautam has been on our show. He's the author of Joys of Compounding. We're actually probably going to have him back on the show here because his new book just came out. And Gautam, I know you're watching this. I haven't read it yet. It's the next one on my docket. I promise I'm getting to it, buddy. And I'm excited to see you at Berkshire in a couple months. But Gautam focuses on India and the Indian stock market. And his preference is to have somewhere between around 2 to 3.5% of his portfolio allocated to specific companies. And if it gets to 5%, in many cases, he cannot stomach that volatility. So he would take anything above that and then allocate it to either cash or redeploy it to another company. Now, we just went into the weeds of 3 of the best investment minds in the world. But what's really cool is they are protecting themselves from their investment inefficiencies but more importantly, they're protecting themselves from themselves. That's where asset allocation is incredibly valuable. Now, I'm also going to tell you your asset allocation, it is going to change over time, and it needs to be fluid based on the circumstances that are presented in front of you. So what used to be the case with asset allocation is back in the day, this was planning, by the way. This was financial planning 101, which is freaking crazy to me. You would take 100, you would subtract your age, and then whatever's left over, that should be the percentage of your portfolio in the stock market, and then whatever's left over is within the bond market. And that was kind of it over time, which is wild. And we were able to get away with that because, not to get into the weeds, but as interest rates were dropping over the previous couple decades, bond prices increased, so you actually got away with that. Nowadays, it is increasingly more fluid and dynamic. So if you are growing your net worth, okay, would it make sense for most people to have any type of bond within your portfolio for the long haul? Probably not. And the reason why is, why would you invest in an IOU when you could own equity in a business where you have basically unlimited upside with that business, versus the IOU, you're only getting what the IOU is worth? So whether it's in the stock market, or let me rephrase that. If you invest within the stock market, you better have an allocation according to what makes sense to you. And it may not be just the stock market. And as far as stocks go, it could be mutual funds, it could be index funds, it could be a hybrid of the two. Let's say you start getting into alternative investments like real estate or private equity or private credit. Now you need to start thinking about, okay, how am I going to allocate that accordingly? But dig deeper. What's going on right now in the world that we live in? I can tell you, as of this recording, interest rates are kind of all over the place. So with interest rates being all over the place, real estate might be, for our compliance people listening in, more risky than it has been in the past. Because generally speaking, when interest rates just plummet, real estate in stocks and businesses, they love that. Private credit actually can hedge a lot of that. So if interest rates rise, if you're invested in floating rate loans, again, not investment advice, I'm just getting you to think about this stuff, it may make sense to have more of an allocation towards private credit. It may. So it's never just this set in stone thing. And then when you get to retirement, asset allocation does not become nearly as important as making sure that your dollars are located accordingly throughout your financial plan, so you can maintain your standard of living and then secondarily grow your net worth for your future needs, long-term care, and your heirs. That's a totally different framework of money, but in my humble opinion, I think it's the right one. So I want to conclude with one action step for you in order to truly understand your own asset allocation. Instead of thinking about it the broken traditional way, work your way backwards within my framework, whether it's within our masterclass or whether it's within our book online. I lay all of this out for you in intricate detail. And if you're growing your net worth, regardless of what you are sticking with, whether it's the market or these alternative investments I mentioned earlier, you are going to have to figure out what you are comfortable with. And just because you are comfortable with something and your friends and your peers are not, that doesn't mean that they're wrong and you're right. You just have a different flavor. And as I've said many times in the past, Dr. Craig Israelson out of BYU, one of my favorite professors, and frankly, one of my favorite episodes that we recorded that I wish got a whole heck of a lot more coverage because I learned a ton from that episode. Investing and planning is like salsa. Everyone loves salsa. Some people like it sweet, spicy, fruity, smoky. But at the end of the day, as long as you figure out your salsa, that is what is going to work for you. So that concludes today's two-parter on risk tolerance. We obliterated the snot out of it. and asset allocation. And now you know that asset allocation is not something where you just fixate on one number or two numbers and you just let it ride. It is hard. You need to work at this stuff. But I will tell you right now, the more you work and the more you realize that you can never stop learning, your financial success will go leaps and bounds, not only beyond your peers, but beyond what you would ever begin to dream of. So that does it for today's episode. If you had any questions about what we went over, if you have any questions about your personal financial situation that you want me to answer on the show, if you have any personal questions you want me to just answer for you behind the scenes, or if you want to be a guest on Capitalize Your Finances podcast and come on into the studio, head on over to capitalizepodcast.com. Hit me and my team up with an inquiry. We look at it every single day. We try to get back to you within 48 business hours. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. An asset allocation strategy does not ensure a profit or protect against loss. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial and inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Christopher A. Paniotu is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Monish Pabrai or any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.